A strong grasp of insurance vocabulary is essential for passing your life and health insurance license exam. In this video, we'll cover key insurance terms, core life and health concepts, and policy language and definitions. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
Let's start with a review of insurance contract terminology. Contract elements. In an insurance contract, what does the term consideration refer to? Is it A, the legal capacity of the parties involved? B, the premium paid by the insured and the promise to pay by the insurer? C, the conditions under which the contract is valid? Or D, the agreement to the terms of the contract? The answer is B, the premium paid by the insured and the promise to pay by the insurer. Why this question may seem a bit tricky, the term consideration can be confused with other contract elements. It specifically refers to the premium paid by the insured and the promise to pay by the insurer. An insurance agent needs to determine the insurable interest in a policy. If John insures his own house, what is the insurable interest? Is it A, the market value of the house? B, the replacement cost of the house? C, John's financial stake in the house? Or D, the potential profit from selling the house? The answer is C, John's financial stake in the house. Why this question may seem a bit tricky. The term insurable interest can be misunderstood. It refers to the financial stake John has in his house, not the house's market value or replacement cost.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which element of an insurance contract ensures that the contract is legally enforceable? Is it A, legal capacity? B, consideration? C, offer and acceptance? Or D, insurable interest? The answer is A, legal capacity. Why this question may seem a bit tricky. Legal enforceability requires several elements, but legal capacity is crucial as it ensures parties can enter into a contract. A policyholder is reviewing their insurance contract and wants to understand the offer and acceptance process. If the insurer offers a policy and the policyholder pays the premium, what does this signify? Is it A, the policyholder's consideration? B, the insurer's consideration? C, the policyholder's insurable interest? Or D, the policyholder's acceptance of the offer? The answer is D, the policyholder's acceptance of the offer. Why this question may seem a bit tricky. The process involves both parties agreeing. Payment of the premium signifies acceptance of the offer. Policy clauses and provisions. In an insurance policy, what does the incontestability clause typically prevent after a certain period? Is it A, prevents policy cancellation due to non-payment? B, prevents changes to premium rates? C, prevents voiding the policy for misstatements? Or D, prevents changes to beneficiary designations? The answer is C, prevents voiding the policy for misstatements. Why this question may seem a bit tricky. The distractors suggest incorrect interpretations of the clause's purpose. The incontestability clause prevents the insurer from voiding the policy for misstatements after a specified period. An insurance agent needs to calculate the premium refund for a policyholder who cancels their policy within the free look period. If the policyholder paid $1,200 annually and cancels after 10 days, what is the refund amount, assuming a 30-day month? Is it A, $1,160? B, $1,160.67, C, $1,200, or D, $1,180? The answer is B, $1,160.67. Why this question may seem a bit tricky. The distractors use incorrect time periods or miscalculate the daily rate. The correct approach is to calculate the daily rate and multiply by the remaining days. What is the primary purpose of the grace period provision in an insurance policy? Is it A, allows extra time to pay the premium, B, allows for policy cancellation without penalty, C, allows for changes to policy terms, or D, allows for a refund of premiums paid? The answer is A, allows extra time to pay the premium. Why this question may seem a bit tricky. The distractors suggest unrelated policy features. The grace period allows the policyholder extra time to pay the premium without losing coverage. A policyholder with a $500,000 life insurance policy has a suicide clause that excludes coverage for the first 2 years. If the policyholder dies by suicide 18 months after the policy is issued, what is the payout? Is it A, $500,000, B, $250,000, C, $0, or D, refund of premiums paid? The answer is D, refund of premiums paid. Why this question may seem a bit tricky. The distractors suggest incorrect payout scenarios. The suicide clause excludes coverage, so only premiums paid are refunded.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Misrepresentation and concealment concepts. In the context of insurance contracts, what does the term misrepresentation refer to? Is it A, omission of material facts, B, providing false information, C, failure to update policy details, or D, exaggeration of policy benefits? The answer is B, providing false information. Why this question may seem a bit tricky. The options include terms that sound similar but have different meanings. Misrepresentation specifically refers to providing false information. An insurance applicant fails to disclose a pre-existing medical condition. How might this be classified under insurance contract terminology? Is it A, misrepresentation, B, fraud, C, concealment, or D, non-disclosure? The answer is C, concealment. Why this question may seem a bit tricky. The options include terms that are often confused. Concealment specifically involves withholding information. What is the primary difference between misrepresentation and concealment in insurance contracts? Is it A, misrepresentation involves false statements, concealment involves hiding facts, B, both involve providing false information, C, concealment is more severe than misrepresentation, or D, misrepresentation is unintentional, concealment is intentional? The answer is A, misrepresentation involves false statements, concealment involves hiding facts. Why this question may seem a bit tricky. The terms are related but distinct. Misrepresentation involves false statements, while concealment is about hiding facts. An insurance policyholder intentionally provides incorrect information about their age to get a lower premium. How is this action classified? Is it A, concealment, B, non-disclosure, C, fraud, or D, misrepresentation? The answer is D, misrepresentation. Why this question may seem a bit tricky. The options include terms that are often used interchangeably. This scenario is a clear case of misrepresentation. Life insurance product vocabulary. Life insurance policy types. What is the primary purpose of a term life insurance policy? Is it A, to build cash value over time? B, to provide coverage for a specific period? C, to offer lifelong coverage? Or D, to pay dividends to policyholders? The answer is B, to provide coverage for a specific period. Why this question may seem a bit tricky. The distractors might confuse the purpose with features of other policy types. Term life insurance is specifically for temporary coverage. An agent needs to calculate the premium for a whole life insurance policy. If the annual premium is $1,200 and the policyholder pays monthly, what is the monthly premium? Is it A, $100, B, $120, C, $150, or D, $90? The answer is C, $150. Why this question may seem a bit tricky, the distractors might result from dividing incorrectly or misunderstanding the annual to monthly conversion. Which type of life insurance policy typically includes an investment component? Is it A, universal life insurance, B, term life insurance, C, whole life insurance, or D, group life insurance? The answer is A, universal life insurance. Why this question may seem a bit tricky, the distractors might confuse the investment feature with other policy benefits. Universal life insurance includes an investment component. What is the primary difference between term life insurance and whole life insurance? Is it A, term life insurance has a cash value component? B, whole life insurance includes a cash value component? C, term life insurance is more expensive than whole life insurance? Or D, whole life insurance is only available for a fixed term? The answer is B, whole life insurance includes a cash value component. Why this question may seem a bit tricky, the distractors may confuse the duration and cash value aspects. Term life is temporary without cash value, while whole life is permanent with cash value. Non-forfeiture options. What is the primary purpose of the cash surrender value option in life insurance non-forfeiture options? Is it A, to provide a loan against the policy? B, to allow the policyholder to receive a cash payout upon surrender? C, to extend the policy term without additional premiums? Or D, to convert the policy into a paid-up policy? The answer is B, to allow the policyholder to receive a cash payout upon surrender. Why this question may seem a bit tricky, the distractors might confuse the purpose with other non-forfeiture options. A cash surrender value allows policyholders to receive a cash payout if they surrender the policy. An agent needs to calculate the reduced paid-up insurance value for a policy with a cash value of $10,000 and a net single premium of $500 per $1,000 of coverage. What is the amount of paid-up insurance? Is it A, $20,000, B, $5,000, C, $50,000, or D, $2,000? The answer is A, $20,000. Why this question may seem a bit tricky. The distractors use incorrect calculations or misunderstand the net single premium. Divide the cash value by the net single premium to find the paid-up insurance. Which non-forfeiture option allows a policyholder to maintain coverage for a reduced amount without paying further premiums? Is it A, cash surrender value, B, extended term insurance, C, policy loan, or D, reduced paid-up insurance? The answer is D, reduced paid-up insurance. Why this question may seem a bit tricky. The options might seem similar. The reduced paid-up insurance option allows maintaining coverage without additional premiums. What does the extended term insurance option provide to a policyholder? Is it A, the same coverage for a limited time without further premiums? B. A cash payout upon surrender. C. A loan against the policy. Or D. Reduced coverage without further premiums. The answer is A. The same coverage for a limited time without further premiums. Why this question may seem a bit tricky. The distractors might confuse the option with others. Extended term insurance provides the same coverage for a limited time without further premiums. Policy riders. What is the primary purpose of an accidental death benefit rider in a life insurance policy? Is it A. To reduce the premium cost? B. To provide additional benefits if death occurs due to an accident? C. To cover medical expenses? Or D. To increase the cash value of the policy? The answer is B. To provide additional benefits if death occurs due to an accident. Why this question may seem a bit tricky. The distractors might confuse the rider's purpose with other policy features. The correct purpose is to provide additional benefits if death occurs due to an accident. Which of the following best describes a guaranteed insurability rider? Is it A. Allows for additional coverage without evidence of insurability? B. Provides a refund of premiums paid? C. Increases the death benefit automatically? Or D. Reduces the policy's cash value? The answer is A. Allows for additional coverage without evidence of insurability. Why this question may seem a bit tricky. The distractors might confuse this rider with other policy features. The correct description allows for additional coverage without evidence of insurability. What does a cost of living rider typically adjust for in a life insurance policy? Is it A. Adjusts for changes in health status? B. Adjusts for changes in policyholder's age? C. Adjusts for inflation to maintain policy value? Or D. Adjusts for changes in premium rates? The answer is C. Adjusts for inflation to maintain policy value. Why this question may seem a bit tricky. The distractors might confuse the rider's adjustment with unrelated policy features. The correct adjustment is for inflation to maintain the policy's value. What is the primary purpose of an accidental death benefit rider in a life insurance policy? Is it A. To cover funeral expenses? B. To provide extra payout if death occurs by accident? C. To waive premiums if the insured becomes disabled? Or D. To increase the cash value of the policy? The answer is B. To provide extra payout if death occurs by accident. Why this question may seem a bit tricky. The options include benefits that are not related to accidental death. The correct purpose is to provide additional coverage in case of accidental death. Annuity vocabulary. Annuity types. What is a key characteristic of an ordinary annuity? Is it A. Payments are made at the beginning of each period? B. Payments are made at the end of each period? C. Payments vary each period? Or D. Interest is compounded continuously? The answer is B. Payments are made at the end of each period. Why this question may seem a bit tricky. The options include terms that are similar but not specific to ordinary annuities. Ordinary annuities involve payments at the end of each period. A retiree receives a fixed monthly payment from an annuity for 20 years. What type of annuity is this? Is it A. Fixed annuity? B. Variable annuity? C. Immediate annuity? Or D. Deferred annuity? The answer is A. Fixed annuity. Why this question may seem a bit tricky. The scenario includes terms that could apply to different annuity types. A fixed monthly payment over a set period is a characteristic of a fixed annuity. Which of the following best describes an annuity due? Is it A. Payments are made at the end of each period? B. Payments vary based on interest rates? C. Payments are made at the beginning of each period? Or D, payments are made annually? The answer is C. Payments are made at the beginning of each period. Why this question may seem a bit tricky, the distractors include terms that are easily confused with annuity due. An annuity due involves payments at the beginning of each period. An investor purchases an annuity that begins payments in 10 years. What type of annuity is this? Is it A, immediate annuity, B, fixed annuity, C, variable annuity, or D, deferred annuity? The answer is D, deferred annuity. Why this question may seem a bit tricky, the scenario involves future payments, which can be confused with other types. A deferred annuity starts payments after a delay.
Notice the code in the corner? When you're stumped by a question, enter it at Birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Annuity periods and payout options. What does the term annuity period refer to in the context of annuities? Is it A, the initial investment phase, B, the time during which payments are made to the annuitant, C, the time before the annuity starts paying out, or D, the period when the annuity is being funded? The answer is B, the time during which payments are made to the annuitant. Why this question may seem a bit tricky, the distractors include terms related to annuity, but not specifically the period. The annuity period is the time during which payments are made to the annuitant. An agent needs to calculate the payout for a client who has chosen a life annuity with a 10-year certain period. If the client passes away after 7 years, how many more years will the payments continue? Is it A, 0 years, B, 7 years, C, 3 years, or D, 10 years? The answer is C, 3 years. Why this question may seem a bit tricky, the distractors include incorrect calculations of the remaining period. Payments continue for 3 more years to complete the 10-year certain period. Which payout option provides payments for the lifetime of the annuitant, regardless of how long they live? Is it A, life annuity, B, fixed period annuity, C, joint and survivor annuity, or D, deferred annuity? The answer is A, life annuity. Why this question may seem a bit tricky, the distractors include options that limit payment duration. A life annuity pays for the lifetime of the annuitant. A client selects a joint and survivor annuity with a 50% survivor benefit. If the primary annuitant receives $2,000 monthly, what will the survivor receive after the primary annuitant's death? Is it A, $2,000, B, $1,000, C, $500, or D, $1,500? The answer is B, $1,000. Why this question may seem a bit tricky, the distractors include incorrect percentages. The survivor receives 50% of $2,000, which is $1,000. Fixed, variable, and indexed annuities. What is the primary difference between a fixed annuity and a variable annuity? Is it A, fixed annuities have higher fees, B, fixed annuities offer guaranteed returns while variable annuities do not, C, variable annuities are always safer than fixed annuities, or D, both have the same risk level? The answer is B, fixed annuities offer guaranteed returns while variable annuities do not. Why this question may seem a bit tricky, the distractors might confuse the guaranteed nature of fixed annuities with the potential for higher returns in variable annuities. Fixed annuities offer guaranteed returns, while variable annuities depend on market performance. An investor chooses an indexed annuity tied to the S&P 500 with a cap rate of 5%. If the index grows by 8% in a year, What is the investor's credited interest rate? Is it A, 8%, B, 3%, C, 5%, or D, 0%? The answer is C, 5%. Why this question may seem a bit tricky. The distractors might confuse the cap rate application. The credited interest rate is capped at 5%, despite the index growing by 8%. In a variable annuity, what determines the amount of income payments? Is it A, performance of investment options, B, fixed interest rate, C, insurance company's discretion, or D, initial premium amount only? The answer is A, performance of investment options. Why this question may seem a bit tricky. The distractors might confuse the role of market performance with other factors. Income payments in variable annuities depend on the performance of the chosen investment options. A retiree invests in a fixed annuity with a 3% annual interest rate. If they invest $100,000, what will be the value of the annuity after 1 year? Is it A, $100,000, B, $103,000, C, $105,000, or D, $102,000? The answer is B, $103,000. Why this question may seem a bit tricky. The distractors might mislead with incorrect interest calculations. The correct value is $103,000, calculated by applying the 3% interest to the initial investment. Health insurance vocabulary. Cost-sharing terms. What is the primary purpose of a deductible in a health insurance policy? Is it A, to reduce the premium cost, B, to require the insured to pay a set amount before coverage begins, C, to cover preventive services, or D, to limit the total out-of-pocket expenses? The answer is B, to require the insured to pay a set amount before coverage begins. Why this question may seem a bit tricky. The distractors might confuse deductible with other cost-sharing terms like copayment or coinsurance. Deductibles are the amount paid before insurance starts covering costs. How does coinsurance differ from a copayment in health insurance? Is it A, coinsurance is a percentage of costs while copayment is a fixed amount? B, coinsurance is paid before the deductible while copayment is after? C, coinsurance applies only to prescription drugs while copayment applies to all services? Or D, coinsurance is a fixed amount while copayment is a percentage? The answer is A, coinsurance is a percentage of costs while copayment is a fixed amount. Why this question may seem a bit tricky. The distractors might confuse the percentage-based nature of coinsurance with the fixed amount of copayments. Coinsurance is a percentage of costs after the deductible. What does the term out-of-pocket maximum refer to in a health insurance policy? Is it A, the maximum premium paid annually, B, the maximum deductible amount, C, the maximum amount covered by insurance, or D, the maximum amount an insured pays for covered services in a year? The answer is D, the maximum amount an insured pays for covered services in a year. Why this question may seem a bit tricky. The distractors might confuse the maximum with other limits like deductibles or premiums. The out-of-pocket maximum caps total spending on covered services. An individual has a health insurance plan with a $500 deductible and 20% coinsurance. If they incur a medical bill of $2,500, how much will they pay out of pocket after the deductible is met? Is it A, $500, B, $900, C, $1,000, or D, $2,500? The answer is B, $900. Why this question may seem a bit tricky. The distractors may result from misunderstanding when the deductible applies or miscalculating the coinsurance. After the deductible, the individual pays 20% of the remaining $2,000. Renewability and policy type terms. What does the term guaranteed renewable mean in health insurance policies? Is it A, the policy can be canceled by the insurer at any time? B, the policy must be renewed by the insurer, but premiums can change? C, the policy cannot be canceled and premiums cannot change? Or D, the policy can be renewed only if the insured remains healthy? The answer is B. The policy must be renewed by the insurer, but premiums can change. Why this question may seem a bit tricky. The term guaranteed renewable might be confused with non-cancelable. The key difference is that premiums can change in guaranteed renewable policies. An insurance agent is reviewing a client's policy that is conditionally renewable. Under what condition might this policy not be renewed? Is it A, the client turns 65 years old? B, the client files a claim? C, the insurer changes its underwriting standards? Or D, the client moves to a new state? The answer is C. The insurer changes its underwriting standards. Why this question may seem a bit tricky. The term conditionally renewable might be confused with guaranteed renewable. Conditions for non-renewal are often based on specific criteria set by the insurer. In health insurance, what does non-cancelable mean? Is it A, the policy cannot be canceled and premiums cannot change? B, the policy can be canceled if the insured files too many claims? C, the policy must be renewed, but premiums can change? Or D, the policy can be canceled at the insurer's discretion? The answer is A, the policy cannot be canceled and premiums cannot change. Why this question may seem a bit tricky. Non-cancelable is often confused with guaranteed renewable. The key is that both renewal and premium rates are guaranteed. A client has a cancelable health insurance policy. What action can the insurer take at the end of the policy term? Is it A, the insurer must renew the policy without changing premiums? B, the insurer must renew the policy, but can change premiums? C, the insurer can only cancel the policy if the client files a claim? Or D, the insurer can choose not to renew the policy for any reason? The answer is D. The insurer can choose not to renew the policy for any reason. Why this question may seem a bit tricky. Cancelable policies are often misunderstood. The insurer has the right to cancel the policy at the end of the term.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Managed care plan types. Which of the following best describes a health maintenance organization plan? Is it A, allows out-of-network visits without referrals? B, requires members to use a network of doctors and hospitals? C, offers the highest flexibility in choosing healthcare providers? Or D, combines features of HMO and PPO plans? The answer is B, requires members to use a network of doctors and hospitals. Why this question may seem a bit tricky. The options include terms that sound similar but have different meanings. An HMO requires members to use a network of doctors and hospitals. An individual with a preferred provider organization plan visits an out-of-network doctor. If the plan covers 70% of in-network costs and 50% of out-of-network costs, how much will the individual pay for a $200 out-of-network visit? Is it A, $60, B, $70, C, $100, or D, $140? The answer is C, $100. Why this question may seem a bit tricky. The distractors might confuse in-network and out-of-network coverage percentages. The individual pays 50% of $200, which is $100. What is a key feature of a point-of-service plan? Is it A, combines features of HMO and PPO plans? B, requires a primary care physician for all referrals? C, offers the lowest premiums among plan types? Or D, does not cover out-of-network services? The answer is A, combines features of HMO and PPO plans. Why this question may seem a bit tricky. The options include features of other plan types. A POS plan allows using both in-network and out-of-network providers with different cost implications. A patient with an EPO plan needs to see a specialist. If the specialist is out of network, what is the likely outcome? Is it A, the plan covers 80% of the cost? B, the patient pays a higher copay? C, the plan requires a referral for coverage? Or D, the patient pays the full cost? The answer is D, the patient pays the full cost. Why this question may seem a bit tricky. The options include scenarios from other plan types. EPO plans typically do not cover out-of-network services, so the patient would pay full cost. Underwriting and policy issue vocabulary. Underwriting classifications. What does the term preferred risk mean in underwriting classifications? Is it A, individuals qualifying for lower premiums due to better health or lifestyle? B, individuals with high-risk occupations? C, individuals who are denied coverage? Or D, individuals who pay standard premiums? The answer is A, individuals qualifying for lower premiums due to better health or lifestyle. Why this question may seem a bit tricky. The distractors include terms that sound similar but have different meanings. Preferred risk refers to individuals who qualify for lower premiums due to better health or lifestyle. An insurance agent is assessing a client who is a non-smoker, exercises regularly, and has no family history of chronic diseases. Which underwriting classification is most likely for this client? Is it A, standard risk? B, preferred risk? C, substandard risk? Or D, declined risk? The answer is B, preferred risk. Why this question may seem a bit tricky. The scenario includes details that could fit multiple categories. However, the client's healthy lifestyle suggests a preferred risk classification. Which underwriting classification is assigned to individuals who pose a higher risk than average due to health issues? Is it A, preferred risk? B, standard risk? C, substandard risk? Or D, declined risk? The answer is C, substandard risk. Why this question may seem a bit tricky. The distractors include terms that are often confused. Substandard risk is for individuals with higher health risks. A client with a history of heart disease applies for life insurance. The insurer decides to offer coverage at a higher premium. What underwriting classification does this client likely fall under? Is it A, preferred risk? B, standard risk? C, declined risk? Or D, substandard risk? The answer is D, substandard risk. Why this question may seem a bit tricky. The scenario involves health issues that could lead to different classifications. The higher premium indicates a substandard risk classification. Policy receipts. What is the primary purpose of a conditional receipt in the underwriting process? Is it A, to finalize the insurance policy? B, to provide temporary coverage during underwriting? C, to confirm the policyholder's payment? Or D, to guarantee policy approval? The answer is B, to provide temporary coverage during underwriting. Why this question may seem a bit tricky. The options include terms that sound similar but have different meanings. A conditional receipt provides temporary coverage while the application is under review. An applicant receives a binding receipt after submitting their application and premium. If the applicant dies before the policy is issued, what is the insurer's obligation? Is it A, no obligation, as the policy was not issued? B, refund the premium only? C, provide coverage as if the policy was issued? Or D, issue the policy posthumously? The answer is C, provide coverage as if the policy was issued. Why this question may seem a bit tricky. The options include terms that might confuse the reader. A binding receipt obligates the insurer to provide coverage from the date of receipt. Which of the following best describes a binding receipt? Is it A, it provides immediate coverage upon receipt of the premium? B, it guarantees policy issuance upon application approval? C, it is used only for health insurance applications? Or D, it is issued after the policy is approved? The answer is A, it provides immediate coverage upon receipt of the premium. Why this question may seem a bit tricky. The options include terms that are easily confused. A binding receipt provides immediate coverage, unlike a conditional receipt. An insurance agent issues a conditional receipt to a client who has applied for life insurance. If the client is deemed insurable, when does the coverage begin? Is it A, from the date the policy is issued? B, from the date of the application or medical exam, whichever is later? C, from the date the premium is paid? Or D, from the date the agent receives the application? The answer is B, from the date of the application or medical exam, whichever is later. Why this question may seem a bit tricky. The options include similar terms that could confuse the reader. Coverage begins from the date of the application or medical exam, whichever is later. Replacement and conservation concepts. In the context of policy replacement, what does the conservation process primarily aim to achieve? Is it A, increase the policy's cash value? B, reduce the policyholder's premium? C, retain the existing policy? Or D, transfer the policy to a new insurer? The answer is C, retain the existing policy. Why this question may seem a bit tricky. The options include terms that sound similar but have different meanings. Conservation focuses on retaining existing policies rather than replacing them. An agent is reviewing a client's policy for potential replacement. The current policy has a cash surrender value of $10,000, while the new policy offers a $12,000 cash value. If the replacement involves a $1,500 surrender charge, what is the net gain or loss? Is it A, $500 gain? B, $1,500 loss? C, $2,000 gain? Or D, $3,000 gain? The answer is A, $500 gain. Why this question may seem a bit tricky. The distractors include incorrect calculations of the surrender charge or cash values. The net gain is calculated by subtracting the surrender charge from the new policy's cash value. Which of the following is a key consideration when determining if a policy replacement is suitable? Is it A, the agent's commission? B, the policyholder's needs and benefits? C, the insurer's market share? Or D, the policy's advertising campaign? The answer is B, the policyholder's needs and benefits. Why this question may seem a bit tricky. The options include factors that might seem relevant but are not central to suitability. Suitability focuses on the policyholder's needs and benefits. What is the primary goal of the replacement process in insurance underwriting? Is it A, switch to a policy with better terms? B, increase the policyholder's premium? C, reduce the insurer's risk? Or D, enhance the policy's cash value? The answer is A. Switch to a policy with better terms. Why this question may seem a bit tricky. The options include goals that might be associated with other processes. Replacement focuses on switching to a new policy for better terms. Regulatory and ethical vocabulary. Regulatory framework terms. What is the primary purpose of the risk-based capital formula in regulatory frameworks? Is it A, to calculate premium rates, B, to ensure insurers hold enough capital to cover their risks, C, to determine agent commissions, or D, to set policyholder dividends? The answer is B, to ensure insurers hold enough capital to cover their risks. Why this question may seem a bit tricky. The distractors might confuse the purpose of the formula with other regulatory measures. The correct purpose is to ensure insurers hold enough capital to cover their risks. In the context of regulatory frameworks, what does the term solvency margin refer to? Is it A, the excess of assets over liabilities, B, the total value of an insurer's assets, C, the ratio of liabilities to assets, or D, the insurer's annual profit? The answer is A, the excess of assets over liabilities. Why this question may seem a bit tricky. The distractors might confuse solvency margin with other financial metrics. The correct definition involves the excess of assets over liabilities. A life insurance company is assessing its liquidity ratio to ensure it can meet short-term obligations. If the company has $200 million in liquid assets and $150 million in short-term liabilities, what is the liquidity ratio? Is it A, 0.75, B, 1.25, C, 0.5, or D, 1.33? The answer is D, 1.33. Why this question may seem a bit tricky. The distractors might arise from incorrect division or misunderstanding of the ratio's components. The correct calculation divides liquid assets by short-term liabilities. What does the compliance ratio indicate in regulatory terms? Is it A, the ratio of premiums to claims, B, the percentage of assets held in cash, C, the degree to which a company meets regulatory requirements, or D, the ratio of liabilities to equity? The answer is C, the degree to which a company meets regulatory requirements. Why this question may seem a bit tricky. The distractors might confuse compliance ratio with other ratios. The correct interpretation involves the degree to which a company meets regulatory requirements. Producer authority and responsibilities. What is the primary responsibility of a producer when it comes to maintaining ethical standards in insurance sales? Is it A, ensuring all policies are sold at the highest premium, B, acting in the best interest of the client, C, maximizing the number of policies sold, or D, following company sales targets? The answer is B, acting in the best interest of the client. Why this question may seem a bit tricky. The options include tasks that are part of a producer's role but not directly related to ethical standards. The correct answer focuses on ethical conduct. Which of the following is a key component of the suitability standard in insurance sales? Is it A, matching products to client needs, B, maximizing sales volume, C, ensuring policy profitability, or D, following company guidelines? The answer is A, matching products to client needs. Why this question may seem a bit tricky. The options include related concepts, but only one directly pertains to suitability. The correct answer focuses on matching products to client needs. What does the term fiduciary responsibility mean in the context of a producer's duties? Is it A, ensuring all sales targets are met, B, providing the lowest possible premiums, C. Managing client funds with trust and care. Or D. Following all company policies. The answer is C. Managing client funds with trust and care. Why this question may seem a bit tricky. The options include responsibilities that are part of a producer's role, but not fiduciary in nature. The correct answer focuses on trust and financial responsibility. An insurance producer is calculating the premium for a client's life insurance policy. The policy requires a base premium of $500, a state tax of 2%, and a service fee of $20. What is the total premium the client must pay? Is it A, $510, B, $530, C, $520, or D, $540? The answer is B, $530. Why this question may seem a bit tricky. The distractors may result from incorrect percentage application or omitting the service fee. The correct approach is to calculate 2% of $500, add it to the base premium, and then add the service fee. Consumer protection terms. A consumer purchases a product with a warranty that covers 80% of repair costs. If a repair costs $500, how much will the consumer pay out of pocket? Is it A, $400, B, $100, C, $500, or D, $0? The answer is B, $100. Why this question may seem a bit tricky. The distractors might mislead by suggesting incorrect percentages or calculations. The consumer pays 20% of $500, which is $100. What does the term cooling-off period refer to in consumer protection? Is it A, the time a product is under warranty, B, the time a product can be returned for a full refund, C, the period to cancel a contract without penalty, or D, the time a consumer has to pay a bill? The answer is C, the period to cancel a contract without penalty. Why this question may seem a bit tricky. The options might confuse similar terms. The cooling-off period allows consumers to cancel a contract within a specified time without penalty. A consumer protection agency fines a company $1,000 per day for non-compliance. If the company resolves the issue after 5 days, what is the total fine? Is it A, $5,000, B, $1,000, C, $10,000, or D, $500? The answer is A, $5,000. Why this question may seem a bit tricky. The distractors might suggest incorrect multiplication. The fine is $1,000 per day for 5 days, totaling $5,000. In consumer protection terms, what is redress? Is it A, a legal document outlining consumer rights, B, the process of returning a faulty product, C, a period to reconsider a purchase, or D, compensation for loss or harm? The answer is D, compensation for loss or harm. Why this question may seem a bit tricky. The options might confuse with similar terms. Redress refers to compensation or remedy for a consumer who has suffered loss or harm.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.